If you are trying to plan your financial future right now, you are probably feeling pulled in two entirely opposite directions. On one side, you're told to prepare for total economic devastation. On the other, you're warned that if you don't buy immediately, you will be priced out forever. Neither of those extremes is going to happen. If you are waiting on the sidelines for a massive, sweeping collapse to swoop in and buy cheap real estate, or if you are expecting the blind bidding wars of the pandemic era to return, 2026 will leave you completely behind. The reason your newsfeed is oscillating wildly between these two outcomes is that most mainstream analysis still relies on single, national averages. They treat a country of over 300 million people as if it operates on one localized thermostat. To drive engagement, media outlets constantly compare today's economic friction to the most traumatic financial event in recent memory, the 2008 housing collapse. The math simply does not support either a national crash or a national boom for 2026. Those binary narratives are false. To see where the market is actually heading, we have to throw out the sensationalism and look closely at the underlying structural data. The 2026 real estate landscape is the exact inverse of the 2008 collapse. Back then, developers had wildly overbuilt, flooding the market with excess homes that eventually tanked property values. Today, we face a crisis of scarcity. Measuring demographic demand against available physical inventory, the United States is short 3.8 to 5.5 million housing units. That massive deficit didn't happen overnight. After the financial crisis, home building stalled. We're looking at the compounding result of over a decade of severe underbuilding. While the housing supply flatlined, the population did not. Millennials are in peak family formation years, and Gen Z is entering the starter home market. These two massive cohorts apply continuous demand onto a minimal supply, and steady immigration only compounds that pressure. This structural gridlock creates a mathematical price floor across the vast majority of the country. Even if high borrowing costs soften buyer enthusiasm, the sheer physical lack of housing units prevents a nationwide crash in property values. But if demographic demand is so intense and supply is so low, why aren't sales volumes and prices continuing to explode everywhere at once? The answer lies in the cost of capital. By 2026, 30-year mortgage rates are projected to settle in the 5.5 to 6.5% range. That is a noticeable drop from recent peaks, but it remains vastly higher than the pandemic-era lows of under 3%. To understand this, look at this pie chart of current homeowners by their locked-in interest rates. A staggering 85 to 90% secured rates below 5%. This creates the lock-in effect. Homeowners refuse to sell, realizing they'd surrender their ultra-low rate. Those locked-in homeowners wear golden handcuffs. They stay put, which artificially chokes off the normal everyday velocity of the real estate market. The demographic demand is entirely neutralized by a refusal to sell. Because traditional sellers are sitting on the sidelines, the available inventory remains permanently constrained. Just as the supply deficit prevents a crash, elevated borrowing costs and locked-in homeowners completely choke off inventory required to fuel a buying boom. So there is no crash, and there is no boom. The reality is that the idea of a singular national housing market is dead. Instead, the market is bifurcating. It is actively splitting apart into dozens of highly distinct, localized microeconomies that operate on totally different fundamentals. Take cities that experienced massive, overheated population influxes during the pandemic. Austin, Texas saw intense speculative buying. Now, as those specific local trends cool, the city is experiencing stark downward price corrections. We see the exact same cooling effect in places like Boise, Idaho. Without a continuous stream of remote workers artificially inflating demand, local prices are stagnating and correcting downward to match the true regional income levels. But look closely at the Midwest. Metros like Chicago are ignoring those downward corrections entirely. Driven by strong local employment and relatively affordable baseline housing, they are steadily climbing and reaching new all-time highs. Cleveland is on the same upward trajectory. It's a different reality than the Sunbelt, driven by quiet, sustainable, localized fundamentals rather than a speculative rush. The buyers succeeding in this environment are actively adapting to local realities. They are purchasing smaller footprints, combining resources for multi-generational living, and targeting localized pockets of affordability rather than waiting for national rates to bail them out. Navigating 2026 means tuning out the broad, viral predictions of catastrophe or sudden wealth. Success belongs to those who truly understand the underlying structural data and focus entirely upon the specific, localized fundamentals of the exact neighborhood they actually want to live in.